talking about this basic principle in value investing, which is understanding our margin of safety, which is this bar I always mention, right? Which I call the margin of safety, which is a bar that's all the time going up or down, depending on market conditions, depending on if there's a war out there, or depending on the businesses you go and decide to buy, you know. And we were talking about how a market that's undervalued will make your margin of safety go up a lot. And specifically, when you have many stocks that are extremely cheap, that might create a lot of security, of safety in investment packages with many stocks. Nowadays, the world is being cheated on because they are addicted to buying these diversified packages, buying many companies at the same time. But you know, what is saving you is not the fact that you buy many companies, but the fact that you are diversified and the upside of one company might cover the downside of the other ones. And for that to happen, you need the businesses to be undervalued. However, a bias that people have nowadays, and sadly they fall into it a lot, is that if I'm buying a basket with 100 companies, that means the investment package is good per se. And it's not like that. It's not like that. You know, the truth is that, and I was explaining that in the previous video, let's say you have a package with 10 investments. To make it more simple to illustrate, we're going to use 5. You know, let's say you have 5 investments in your package. When the market conditions are in a special condition where everything is very undervalued, or what's going on with my fund right now is like there's so many securities out there, so people cannot focus on all of them. And second, when you have so many companies, you don't have funds with enough capital to buy them all. Okay? So when things are extremely undervalued, I showed you in the previous video that, for example, you might have one that's 10 cents on the dollar. Okay? And when a business is on 10 cents on the dollar, it means that if they become the next Apple or a big company, let's say the next Costco, or the next Cisco, or the next important company, this valuation is going to correct to be like $4 on the dollar or $3 on the dollar, which is a 30x multiple of this. I'm not going to write 30x here, I'm just going to write 3x, because what normally happens is that companies tend to fluctuate from, let's say, 20 cents on the dollar, to make it more realistic, or 40 cents on the dollar to 40 cents, 60 cents on the dollar, and then they go back to be undervalued, because if they're undervalued, there's a reason behind it. So companies are all the time fluctuating in price. But the message of this video is that when things are so undervalued, what happens with your margin of safety is that it goes up. Sorry, I'm going to use blue one. The blue one is working better. So what happens with your margin of safety, MS stands for that, is that it tends to go up. And then if things are more undervalued, it goes even more high. It's more safe to invest. And what we do in my fund is that when we cross this line we have, based on the market conditions, we start investing. Okay, we said this is enough. it will be foolish not to buy this, so we go ahead and buy. So the margin of safety is so high because when companies are so undervalued, by having one company correct price and go from 10 cents on the dollar to 30 cents on the dollar, or from 20 cents on the dollar to 60 cents on the dollar, or from 25 cents on the dollar to $1 on the dollar, that will be 4x. Okay, your stock is growing so much that even if these other choices are completely destroyed, you know, your winners will cover your losers. And then what's the normal thing that's going to happen? The normal thing is that all stocks will do all right because businesses want to stay in business. That's why they got to the situation of being a publicly traded company, you know? And yeah, so basically everything does all right. However, in case of a catastrophe, let's say that you invest in other free countries in these investments and the free countries go into a conflict or a war, self-destructive, or they go into communism, they start destroying the business and the profitability of it, as it might happen in some state-run companies. Even if those businesses don't do well, these winners are going to cover your losers, the upside of these businesses. Okay? And only by having two doing well, it doesn't matter if the other ones don't do well. And then what happens if everything does well? You start to get me there? You know, it's very powerful to understand this. And then you can get so distracted, you know, going ahead and starting short investing, starting other approaches to investing, doing investments on blue chip stocks, where you aren't buying undervalued anymore, but you are rather trading on feelings and understanding if this company is gonna be much more attractive in the future. But yeah, when you're trading very undervalued businesses, you can understand how your margin of safety becomes so high. Okay, and the thing with public stocks is that you have very very easy to sell, very liquid investments. Then you can go out there in the world and buy things for pennies on the dollar or even almost for free if you go into private businesses or into buying small businesses like I heard many people do nowadays with seller financing and all of that. Perhaps you buy a business for 20 cents on the dollar, but you know, then good luck reselling it, because if you're buying something that's cheap because it's hard to sell, then good luck selling it yourself. The advantage of publicly traded stocks, in case the public markets keep growing, is that we are talking about very liquid and easily tradable businesses where you can be a passive investor, and these businesses aren't necessarily going to fail if you don't step in. Okay, then out there you might have many businesses for 20 cents on the dollar out there which need a manager. So if you're buying the business, you really need to go and make the business work. Okay, and then maybe you can get some sweet dividends. However, what I'm saying is now in the public markets, due to the current market conditions, you can get very, very good deals because of this. And if you understand risk management, and before considering if it's good to invest or not, you have to see the package of investments you design and then decide if this package is absolutely great or if it isn't so great. And what makes an investment package great is that the upside of these companies could be great. I remember I was like changing the structure of the portfolio I managed, and I had some pharmaceuticals, okay, and those pharmaceuticals have huge upside because they were approving some drugs for the first time, and they were selling them and so on. So the upside of those companies was great. Then the price of that stock went up, and I decided to take it away from the portfolio and get into more stable stocks that don't require FDA approval and all of that. But the thing is that when I was analyzing the portfolio in those times, I was saying the upside of this pharmaceutical is great. It could cover 2 or 3 stocks I have here that if they don't perform, this pharmaceutical is going to cover them. And actually I was right about that pharmaceutical. It almost doubled in price. However, I decided to invest in other things after I traded for a profit. And when I analyze my package, all the stocks I have, I wonder if I really have big winners there. And if the answer is yes, you can conclude that your margin of safety is great and you're selling a safe product. You're selling a diversified product that isn't only great and might do great in the future, but also is safe because you have multiple players that can cover each other if one of those players underperform, or even if one of those players is completely wiped out, which is a very rare situation. And even if that situation happens, as I explained you in previous videos, because I'm buying for pennies on the dollar at the time of liquidation of a company, sometimes I end up making more money than if I wait for the price to correct. Okay, sometimes the liquidation is more profitable for me than the correction of the price itself. Okay, but yeah, that's basically it. That's why pennies on the dollar brings safety to the portfolio. That's why in Can Capital we have a high margin of safety, and I hope my communication skills today were better, and I will go and try to improve myself even better on that front. But yeah, so that's it basically, and I think the video is gonna be a little bit longer than the previous one, but I guess the message is still the same. And I hope you liked it and you found it valuable and useful. And as always, remember to check out my website and my book, my last publication. It's a great read, and of course it's going to introduce you to many other principles, many other basics you have to know. And yeah, I hope you liked it. You know, this is basically margin of safety 101, you know, margin of safety. MS, you know, margin of safety. You can go and read the book with the same title from Graham and Dodd, or even better than that, The Intelligent Investor. Okay, but yeah, this is used in finance a lot, or at least on the specific approach I have to the markets. Okay, so that's it. Thank you for watching. Wish you all the best, okay? Blessings.